Hey there, folks. This is Deeksha Janiani representing Team Trendline. In this week's video, we will discuss a banking stock that has been buzzing in trade. IndusInd Bank came back in limelight ever since July 2022. So, we will firstly discuss the recent financial performance of the bank. We will then discuss the asset quality concerns that plagued the bank in the past. And finally, we will analyze the medium term growth strategies of the bank. So, let's get into it. The consumption levels in India revived strongly post March 2022. This improved the business sentiment, giving the much needed boost to banking space. The effect of this could be clearly seen in the performance of top banks in Q1 FY23. In fact, RBI also embarked on a new rate hike cycle in May 2022. This will improve the net interest margins of the banks who have a higher proportion of their loans linked to external benchmark rates. Analysts like Morgan Stanley also are positive on this sector because they believe that corporates will put in fresh capex in the next 2 to 3 years. Even RBI echoes similar sentiments. Due to these reasons, Nifty Bank Index jumped over 15% in the past quarter. IndusInd Bank outshined other banks in terms of returns. In fact, this bank was also undervalued as compared to Nifty Bank and was trading at a PE of 12 to 13 times in the first week of July. So this bank actually outperformed the Nifty Bank and Nifty 500 index by over 30 percentage points in the past quarter. And there are a number of reasons which fueled this rally. Firstly, the bank's net profit jumped 61% year on year to 1631 crores in Q1 FY23, led by over 15% growth in net interest income and lower provisions. However, operating profit growth lagged the NII growth owing to higher expenses. The bank was also positive on its flagship vehicle financing segment, backed by high growth expectations of the original equipment manufacturers. The bank shareholders also went on to reappoint the CEO Sumant Katapalia for a term of 3 years, removing the uncertainty surrounding the leadership team. Lastly, the bank unveiled a medium term growth plan, calling it the Planning Cycle 6, in its analyst meeting held in July 2022. But before we discuss this planning cycle 6, let us discuss the asset quality concerns and corporate governance issue that occurred in the bank's past. Now, IndusInd Bank stock has had quite a bumpy ride in the past few years, making investors wary of putting in money in the stock. This dates back to a financial crisis that occurred in 2018 and caused an upheaval in the banking space and affected the bank's image. Infrastructure leasing and financial services company was a holding company of the ILFS group, which consisted of 250 subsidiaries. Now, this group defaulted on loans of over 94,000 crores in that year, uh, within which 60,000 crore was owed to a consortium of banks. IndusInd Bank was one such bank which had extended an unsecured loan of 3,000 crore to this group. Now, when this crisis came out and open in Q2 FY19, the bank had provided provisions of only 14% to cover this account. However, investors felt that the bank had downplayed the situation because the provisions later rose to 70%, and by Q4 FY19, the bank had to mark the entire loan as a non-performing loan. Eventually, its gross NPA jumped over 3,900 crore and its net NPA ratio doubled to 1.2% in just one quarter. Now, the bank held in the earnings call of Q4 FY19. The CEO Romesh Sopti, who later retired in 2020, stated that bank had learned its lesson from this crisis and had taken a number of steps. Now, the bank had made a full-fledged policy on financing holding companies for its internal team. The bank had also set up a portfolio management unit so that such event can be identified beforehand. However, investors found these steps unconvincing because the bank had exposures to other stressed accounts and risky sectors like real estate, microfinance, and telecom. Now, the bank lost 80% of its value between June 2018 and March 2020 from the double whammy of the ILFS crisis and the pandemic. Fast forward to November 2021, another corporate governance issue came to the forefront. The bank's microfinance subsidiary, Bharat Financial Inclusion, had extended loans to 80,000 customers without their consent, owing to what they called as a technical glitch. In fact, this is a classic case of loan evergreening, wherein loans are extended to a person because the proceeds can be applied to recover the existing loans. So the bank In fact, the bank lost investors' trust because it had failed to disclose this issue when it had originally occurred in May 2021. See, as a matter of fact, microfinance loans are always collected back in cash. And the cash flows of the rural population in India was adversely affected after the second pandemic wave. So, this could be a possible cause behind the loan evergreening. Now, as the bank seeks to put this issue behind and it is gearing up for the future, um, it its focus is again on the microfinance segment. Now, see, as a matter of fact, the bank's net NPAs fell on a year-on-year basis in Q1 FY23, but the NPA ratio of the microfinance segment inched even higher. In fact, the share of the microfinance segment in the gross NPAs of the bank rose to 17% in Q1 FY23, although it contributed only 12% to the advances of the bank in the same period. The bank is seeking to it seeks to have a higher growth from this segment despite its inherent risks. So, moving on to the medium term strategies of the bank. So, the bank seeks to grow its loan book at a CAGR of over 18% between FY23 and FY26. This is more than the growth forecast of 15 to 18% for FY20 to FY23. Now, the bank seeks to achieve a sustainable growth in the medium term. Let us decode this word sustainable. So, the bank seeks to achieve a healthy growth in its advances while maintaining the asset quality, having healthy level of provisions, having a good credit to deposit ratio, and lower unsecured credit. Now, the bank is basically betting on the retail segment to hit this targeted growth figure. It seeks to increase the share of retail advances in its overall advances to 60% by FY26 from 54% currently. See, in fact, the corporate segment will also grow at a CAGR of 15 to 20%, but the retail segment will grow faster at a CAGR of say 20 to 20% in the next 3 years. This strategy is quite understandable because the bank faced stress in its corporate loan segment earlier, which we discussed. So, within its corporate segment, the bank is actually focusing on small corporates and mid-sized corporates. Now, even though the focus of the bank on retail segment is quite clear, the growth that its loan book achieved in the past 2 years is mainly because of the corporate segment. Yes, that's right. Now, the corporate loan segment actually gained share within IndusInd Bank's portfolio, and the commercial vehicle lost share because there was a general slowdown in the vehicle segment in the last 2 years. Now, within the retail segment, the bank looks to gain market share in vehicle financing, in business banking, and in microfinance. Now, within its flagship vehicle financing book, the bank is focusing on used cars, tractors, and commercial vehicles. Now, tractors, in fact, were the fastest growing product for the bank in last 2 years. However, the fortunes of this product, depend on the demand recovery in the rural areas of India, which are still reeling under inflationary pressures. Now, another thing is that the bank seeks to achieve high growth CAGR of 25 to 30% from its microfinancing book. Now, within microfinancing, this growth will be driven by vehicle loans, merchant loans, loan against property, and personal loans. Now, see, basically at this point, you should understand that a microfinance loan is an unsecured loan extended to a household which has an annual income of less than 3 lakh. Yes, that's right. Now, see, the bank now it lends to joint liability groups, which consist of 5 to 6 women. And now it is seeking to move to the individual categories of loan, which are actually riskier than these joint liability groups. Now, the bank is also focusing on the merchant loan segment. The bank seeks to tap the potential of 5.5 lakh nano retailers across 30 cities in India. Now, see, nano retailer could be operating a fancy store, a medical store, or a grocery store, and these do not have formal access to credit. So, of course, these are affected in the economic downturns and are usually unable to repay their loans. Now, the bank is also betting on new growth categories like affordable housing, wealth management, and MSME credit. Now, see, the bank used to earlier lend home loans through its partnership with HDFC. However, now it is looking to build an affordable housing loan book of 10,000 crores by FY26. In fact, it sees the home loan market itself doubling to 48 lakh crore between FY22 and FY26. The bank also sees an unmet credit demand of 20 lakh crore in the MSME segment. See, the micro, small, and medium enterprises bore the brunt of the pandemic due to lack of liquidity. These enterprises were ultimately supported by the government. However, according to the earnings call of Q1 FY23, the bank sees this segment growing at a CAGR of 20 to 25%. And it is yet another risky sector. And in fact, let me tell you that the MSME segment will form a part of the business banking segment of the bank, which is in turn part of the consumer financing division. On the deposits front, the bank seeks to have a higher proportion of low cost current account and saving account deposits in its portfolio. In fact, it seeks to raise the CASA deposits to over 45% by FY26, because this will help it in reducing its credit cost and also improving its net interest margins. See, all in all, the bank is focusing on groups like nano retailers, small enterprises and small corporates, households in rural and semi-urban regions to drive the next phase of growth. And see, these are inherently risky sectors which may actually jeopardize the bank's aim to achieve sustainable growth over the medium term. Let me tell you here that IndusInd Bank has, of course, learned its lesson from the crisis of 2018, and there has been a management change also occurring there. But see, the bank is ultimately looking to these risky segments to drive the next phase of growth, which are actually which might cause it some pain in the economic slowdown. See, the DNA of an organization is hard to change, even with the change in the management. So while IndusInd Bank is especially an interesting stock in the banking sector, it is still to prove its skeptics wrong, and hence the next few quarters of its performance are especially crucial. So I hope you must have gained some interesting insights about the medium term growth strategy of IndusInd Bank. So this was my time. Thank you so very much and have a great day.